Hi, this is Pat O'Meara. It's great to have you with us. I'm with the Inveniam team. Today we're without Rick, but we've got Kevin Cutterback, our chief data scientist. We've got Albert, who runs our AI business. And we're joined by David, Maria, and John, who are super excited. We're talking about oracles and data that's at the edge, and what is the future on how compute is going to receive data from many different locations. And so why don't I start this out with David. Give us a quick introduction, yourself and the role that you play.
Sure. So I'm with Houlihan Lokey. I sit inside a group that does valuation of assets, particularly private assets. And as we look at the market, we have historically been an all-inclusive consumer of data. We get paper and we create a product. What's very clear in the private market is, as it has scaled and become huge, we would like to be able to simply add our special expertise to what is a trustable existing pile of data about the assets. And that pile of data can be something that can be shared across a variety of providers. So from my perspective, if I could be on the edge, and yes, Pat, I'm on the edge. If I'm on the edge, I want to be able to trust that data. I want to be able to add my secret sauce and do my particular expertise really well in scale and reduce my liability to just what I do well.
Fantastic. And David, you're sitting where today?
Today I'm in Connecticut, down by the water.
Fantastic. Great to have you. Maria, this is your first time on our podcast. We're super excited to have you. Tell us a little bit about yourself and Plum Labs.
Yeah, of course. Thanks for having me. I'll start with I'm in Brooklyn, New York. I don't know if you can tell with the brick behind me, but I'm in Brooklyn, New York. I grew up in capital markets, traded against a number of different assets, and then found myself in the crosshairs of technology and capital markets really quickly after a couple of the major market downfalls that occurred. I was fortunate that I jumped into digital assets pretty early in my career and really got to understand how market structure was going to develop around digital assets. After kind of a couple of key roles at some startups that were building high-scale risk analysis systems, I joined Ripple right before I started Plum Labs. So I kind of had this transition nicely from capital markets into digital, and I joined Plum with an understanding that if digital assets inherits traditional market structure, then there has to be a natural flow of data in from one asset class into the other. And so I started Plum Labs trying to think about, like, if an investment manager like me were to get their hands on all sorts of data across any asset, what are the possibilities in the market? And that's really what we're trying to solve at Plum Labs with a single platform that unifies data and infrastructure and brings data and access back to the front lines.
Great. What a pleasure to have you. We're super excited to be supporting you and your work. It's really needed. John, thanks for coming back with us again. Give us the quick John Elevator Labs story.
Absolutely. Elevator Labs is a SaaS platform specializing in AI, capital markets, and facilities management. I was involved pretty early in some tokenization of real estate efforts, both here in the U.S. and outside and abroad. And I recognize that if we're going to tokenize commercial real estate, at some point we're going to want to develop or modify that real estate. And to do that, we need to integrate with the systems that manage the data for those developments and modifications. So we have intended to build systems that include developers, construction project managers, architects, basically anyone involved in the full life cycle of construction management. And so I'm very excited to be building on the Inveniam platform and handling all of the really nasty facilities details.
Yeah, and that subject matter expertise that you're adding, John, is fantastic. Where it's pretty clear that Inveniam does not have that building, construction, transitioning, handing off to a long-term institutional owner expertise and understanding what is that data, what are those, but just partnering with you so that you can configure our tool in order to deliver that, and then bringing in all sorts of other tools. And I think that really is a big part of what you're doing on a daily basis, right? How does Inveniam partner with all sorts of other tools, and talk a minute about AI and how AI fits in when we're talking about all of this data sitting at the edge, and how is it going to be used, and how do these various different players, right? John, who's got expertise out gathering data from a building information management system and making sure it's in a format that's going to go all the way through. An expert like David's going to touch it, and it's going to end up in Maria's system live at the edge for an institutional investor, right? Does AI play in? How does it play in there?
Yeah, it's a great question. So, the topic of today is oracles and edge computing, and I find the terminology instructive. For those who don't know, an oracle is essentially a trustable reference point for information, data feed about whatever the oracle is designed to provide data about. But the word itself comes from Greek mythology. There were these priestesses that would sit in the temple of the gods, and whenever someone would come for advice from the gods, the priestess would inhale some fumes from a crack in the earth and then receive the insight of the gods and provide prophecy. And when I was younger, I thought, wow, I wonder where I can get some of those fumes. But now that I'm a little older, I'm thinking, where can I get some of that insight of the gods? And I find that portion very illustrative, because people are looking for the exact same thing today. They want key trusted information. They have no idea where it's coming from, where it should come from, what the processes are, what the mindset of the black box AI is that's providing it. And still they're expecting reliable, trustable information about how they should run their business. And it's very much just as much of a dice roll for many companies as it was then to receive information and use it as a truly trustable guidance.
Yeah, the Delphic mandate, right? Since you took us down that route, right, of know thyself, right? We're talking about know the asset, right? And what does the understanding the asset mean, and then the relationship of that asset to other like assets who happen to be trading in the market, and then feeding that into a system that Maria, I think, had some internet problems. Hopefully she wasn't angry with anything we said, and she'll be back in a second. But David, I want to throw that back to you, right? When we talk about the role of Oracle that you play, many times you talk about a chasm, right, between between the person who's doing the evaluation and the person who's performing the risk work, like Maria. Talk about that a little bit.
Sure. If I when we look sort of at the world, and where our responsibility is to create a valuation, you can think about that as coming ex nihilo, right, from nowhere, or you can think about it as coming as part of an environment or an ecosystem. But all of the environmental and ecosystem signals are suspect, is the best word. We have to evaluate all of them on the way in. So when we look out there to gather the observable data about whether it's a private credit asset or private equity or a real estate asset, we have to look at all of that data that's there. And today we've got to evaluate it for accuracy, timeliness, completeness. Is it fraudulent? I mean, all of those things. We have to criticize the quality of the data. When I look at that chasm then, and I see this boiling pile of data that we have to reach from, if I had an oracle who could calm that sea for us and say, no, these are the right pieces, then I would be able to very quickly, and speed I think is important here in markets. I would be able to very quickly be able to take what I need and offer my piece of work back to investors, risk managers, the fund administrators, whichever it is. And the frequency of my ability to do that now is limited by my ability to really collect and assess that underlying data. I could speed my frequency if my data were surfaced to me more accurately and in a more timely way. So if John presents to me information on a weekly basis about usage of facilities, well, that's going to start to inform the frequency of my valuation of a real estate asset. So instead of semi-annually, maybe it's quarterly or monthly, and in a relevant way. So speed and relevance are a function of that data. And then when I look across that chasm, I don't see enemies, I see friends. And I see people with whom I can communicate around a trusted set of data, offer my particular expertise, and speed up a market.
And those friends, collaborators, symbiotic relationships, you know what I mean? As each one picks up speed, the other one picks up speed, right? The more frequent valuations, the more frequent marks is going to feed a risk book that's going to get better data. As John and his assets can feed real-time data. And I think we're going to see volume and velocity of data growing, right? And John, I really want to start with you, kind of next, if we can, as we think about an asset, right? When we're talking about multifamily housing unit and it's got, 60 air conditioning units, right? If they're old, does that impact the valuation? If they're brand new, does it impact the valuation? What is the mechanism by which the data, the relevant data that should matter, is going to flow through you to somebody like David that's then going to go to Maria, where she can work with her clients so that they develop insight, you know what I mean? And where the value really is, and they can understand the risk and where the opportunity is. But it starts with at the asset, and really her tool helping them become their own oracle, right? They control their own data. They haven't lost control of their data. They now are managing it, and they are an oracle that can speak to a broader community. Talk to us a little bit about that.
Sure. I see it as an incentive problem. I talked about this in the last time I was here, but I wanna dig into the disintermediation process of really real estate development. Starting all the way through design, you have a misincentive to underperform, really, or to lose the data that is detailing or tracking underperformance. This data loss or data shedding throughout the whole life cycle of the project should be captured really at the handover process, but now you have a second order of professionals who don't have the training the first order of professionals did not enforce. And so now all of a sudden we're misvaluing, we're misattesting, we're misaligning incentives, and all of that data we shedded was relevant for the valuation all the way at the end. So I think it's important you start with like a terms of reference. What is the terms of reference here? We want to take an asset from design all the way through operation, and we want to get the most favorable accounting treatment for it. To do that, we have to structure our data, and at handover to the asset owners, we want to make sure that there's a very clear understanding of all of the system and how that data is structured for that favorable treatment, and to continue this process in perpetuity, period.
And I really want to get at this because it's huge. And you said life cycle of the project. What you really meant was construction, right, of that project, from design through construction, the shedding of the data, the loss of the data, and then the owner buys it, which really gets directly to the cost of operating that real world asset, right? Which, if I'm a long-term owner, I care about that, right? My operating cost of maintaining that facility, the level of care that went into construction absolutely matters. Am I correct in that? Right. And how do we incentivize? And I think that until the incentivization is correct, this is opportunity for the investor. And Maria, I think that's what you get at, right? Where is the risk? How do I find opportunity, right? And your tool, particularly as we think about how much data, what data do we need, where do we get it in order for you to deliver the value that you're going to bring to your customers?
Yeah, so look, we're talking about a couple of different things here, right? So we're talking about asset creation, asset valuation, and all of those things are important factors when you're trying to move capital from public markets where liquidity is quite locked right now into private assets where, you know, there's a massive opportunity, but honestly, nobody knows how to get access to those products, right? Like that's fundamentally the issue, right? And so digital assets start solving this, digital creation starts solving this, the creation of financial products that are digitally native solves this. But the thing is like creation does not equal distribution, right? Just because something exists doesn't mean people are going to want to buy it, right? And so, you know, you have a ton of brokers in this space who are saying, oh, I have people who want to buy it. How do I get it from point A to point B? So now the pipes and the infrastructure started getting created, okay? But now the problem is still not solved, is like, what is the incentive, like you said, John, for a buyer to actually buy these digitally native tokenized products? And I think this comes down to data, right? And that's really where Plum Labs comes in. Because when you're an investment manager, when you're at an institution, you don't just go and buy a product because it exists, right? You just go to Amazon and like, hey, look, you know, a turtle shaver exists. Like I should buy that. Like, you know, you need to have a reason. It has to fit into your portfolio. You need to be able to analyze that portfolio to see the impacts of it. You have to perform risk analysis to see how that product's going to impact your overall portfolio, things like this, right? And the only way you can do that efficiently is by integrating these new digitally native products and their data into your existing structures, right? And so I think, you know, a missing part of this is not just like the existence of products, but it's like, how do you demonstrate to an investment manager that these products will be profitable? Right? Because at the end of the day, in capital markets, and we all kind of grew up in capital markets, people do things for one of two reasons, right? You either are trying to optimize your process, right? Because that's important. Nobody wants like really big OpEx, or you're trying to profit, right? There's no other reason you do anything. There's no other reason to get up in the morning. You have to do one of those two things. And creation kind of sits outside of both of those things, right? So it's to your point, John, like the incentives have to exist in order for products to be created and bought. And then also we need to demonstrate profits. And I think that's where Plum comes in, is if I can give you access to data and you can model it and you can model a portfolio with these new assets, you're more likely to understand the potential returns and then purchase those products.
Yeah, and I think that as we think about that data flow from the edge, who are the oracles, who's speaking, who's going to speak into the market, and as they speak into the market, you know, it can't be a 10-finger automation in an Excel spreadsheet, you know, or, you know, where think about CMBS or RMBS, where you had servicers lagging data 180, 360 days in order to inform what were credit default swaps that weren't repricing, right? And
100%.
Some people watched the movie. Some of us worked on Wall Street when that was happening. But what happens is that data opacity was being defined as a mechanism where there was not volatility, right? People invest in private markets in order to lower their volatility. When they're not lowering their volatility, they're just lowering their data availability, right? And as we grow, and Kevin, I want to hit this, right? volume of data, velocity of data, right, is only going to grow, right? And there's other V's as well, right, that matter as that data is coming online. And how do we deal with that?
Right. I was, thinking, back in the big data days, everyone kept adding V's, volume, velocity, veracity, value, variability. That there was never any going back. It was always that anytime there was data available, it pretty quickly became mandatory, and people pretty quickly wanted more. As soon as it became tradable, they wanted to get ahead, or they wanted to add something to their model. So it's good to know that the big data experience is still a thing in the age of blockchain and AI.
I mean, but it's not, right? Like no. But it's not, right, Kevin? Because like nobody cares anymore, right? Like this is the problem. So like there's a new set of problems that are beyond the V's, right? In that there's no like standard for new data that's being created, right? So when like big data started answering questions in 2010, big data came out with like a bunch of like data structures, right? And it said, if your data fits into these data structures, we know how to like table it, we know how to index it, and we can probably pump it into some like SQL application thing, right? Like that is like the business model of Snowflake, right? Now it's like, that's cool, but that's only accessible to a bunch of data engineers, and that's it, right? Now, anyone else who wants to access the data and do anything cool with it can't. Now they're relying on this bottleneck, which is IT people, right, to do anything useful with their data. And so like, it's not that big data is still a problem. Like, fine, we've solved that, right? I always say this when I get up on like podcasts and panels and things like that. I'm like, data's like seawater, right? Back in the day, we used to say like data's like the new oil. It's not oil, right? It's not a commodity. There's so much data. Data is like seawater. It's everywhere. It's just that we don't know how to like refine it and make it drinkable by like people who are not engineers. That's why they can't access it. And this like going back to like John's point, right? It's like, I've created all this stuff. How come nobody can consume it? And it's because their models, the application layer, the UI layer where humans can process this information doesn't exist. That's not dynamic to the new data formats that are being created.
Maria, I'm gonna jump in, and I'm gonna say the other problem is the old structure of centralization is assumed. We need all the data to be in one data lake in order for us to utilize it and process it. And that is the fallacy. And the decentralized data solution, where we're going to be able to pull data, prove, origin of it, prove state of data, prove the process moving through multiple solutions, are going to be able to feed people at scale the data they want from many, many different locations, and we need to centralize it. And we're going to be able to use, Albert, I'll throw this out. How long until AI can build an API on demand if the API is documented from one system to another?
6 months ago. So, Maria, I'm going to disagree with you slightly. I think data is the new oil. The problem is it's crude oil, and it comes out of the ground and needs to be refined for a specific purpose. Is it going to be jet fuel? Is it going to be gasoline? Are we going to use the petroleum for plastic products? Like, what are we actually going to do with it? And going back to the Oracle analogy, one of the problems with getting prophecies from the oracles was that often the prophecy could have double or triple meanings, depending on the context and depending on your interpretation. That made the beginning of many funny and tragic stories. Now, the same exact thing happens in AI. There's this one size fits all mentality. Give me more data and more compute, I'll figure it out. It doesn't work that way, because you need contextual, industry specific understanding of what goals are being used. So, or what goals are being pursued. For example, in the context of financial markets, if I say foundation, I mean the underlying concept behind a system or a market. In building construction, when I say foundation, I mean the literal slab underneath a building that holds it up. So the context is really important, and every business has all this data from their operations that can inform and teach an AI how to do the things that business needs to do. But to your point, there is no one size fits all like data source or data format, and there never will be, because different people need data to do different things.
Yeah, David, I want to throw that to you, right? We talked for a couple times about the primary driver of shipping when the London Stock Exchange was financing the majority of shipping was not what was dynamically the best move, hydrodynamically the best for the ship, but rather the hold could be sold in twelfths, right? Yeah. So that it could be financed and traded on the London Stock Exchange before and after. So the market defined what it needed in these different expertises, and to what degree in a trusted environment where we have oracles weighing in, and then let's go to the next step, which is the trustless environment where you have AI agents pulling from you, but they're not sure how much value you, and they're contextualizing with other AI agents.
It feels like you moved from ships, which are really nice and concrete, to a little bit of science fiction for a second. But let me see if I can bridge that gap. When trade finance in particular started, you couldn't see that ship across the world, right? So you had to define it, and that definition had to last for at least the voyage of the ship, and that piece of information in a letter of credit or in something else from a big bank was literally presented as a piece of paper. It blows my mind, but that piece of paper was the trusted environment, and it had terms in it, like we've been talking about. When we go and try to value an asset, the first thing we look at are what are its terms of reference. It has to be contextual, and it has to fit into a model. So when we move then to a world where you're getting lots more data in a much broader context for environmental inputs, not just the specific ones, but the environmental inputs, all of the definitions that need to be assigned to this data have to come with the data. And so for me, I want to know if John's going to be, if I'm going to be looking at a building and John's going to send me a lot of other alternate information, not just rent rolls, but energy consumption or age of equipment. I got to know what that equipment is, what its intended useful life is. All of those things would be contextually relevant for me to speed up my valuation process, so I don't have to go find all of it. So I guess when I hear you talk about that evolution of how to use the data, if I could get the contextual relevance along with the data, then I can move my piece faster, and I can identify for anybody in the market where I varied the result. And so then they can go to me and say, all right, I see that you varied the result because you chose comparables or multiples, not because you had a different understanding of how long an air conditioner lasts. So the contextual relevance of the data that comes through, and that gets hard for humans to handle. So that's the end of the end of me is that gets hard for humans to handle, and that's why I want Albert to handle that for me.
Yeah, and the in a logical argument where we want to get things down to two things: bid and ask, right? And we want as many variables excluded, right? This is in a digital transaction, you got to have all the digital principles, right? Identity, non-contradiction, etc. And Inveniam is the digital principle of the excluded middle. It's not a marketing line, where we can kind of exclude all of the middle conditions. What is the variable of the air conditioning and the mechanical systems, right? How do we exclude these items so we can get the bid ask? We need to do that. And as somebody is putting, and Tom, if you're in the background and hearing this, if you could put Ralph's comments on the screen, and I think it gets directly to what you were saying, John, right? There are some standards that industry by industry that can be ported in with the data. We can get over to Maria so somebody can build a risk book to have multiple different industry segments data integrated to prepare a model that matters. And so I'm going to go to you, John, first, and then back to Maria.
Sure, I'd like to highlight Ralph's question. So Ralph comes from a globally recognized architect perspective. In his mind, every problem is solved with a new CAD model or some type of structured data system. But there are limitations on the people who can work on those systems or even understand what those systems do. And so he spent a large portion of his time training others who are not architects to be able to get the benefits of his wisdom and experience as an architect. And to Albert's point, data is out there, but what an architect does with data versus a lay construction worker is very different. And so if we're training models versus building products, right, we want to have the right teachers first. And so if I'm going to drive or navigate a system, I can be the best pilot, but I'm not Ralph, right? I'm not an architect. But if my system was designed by or for an architect, I may get a lot of the downstream benefit of superior data structure because I had the forethought to do so from an architectural standpoint versus a project management standpoint. I hope that answers your question.
It's a beautiful, beautiful comment. I think it gets to even Albert and Maria disagreed, and Maria was talking about desalinization, and Albert was talking about refinery, right? We're talking about copious things that have value, that need some function done to it for it to be really useful and unlock the value. One trades more per barrel than the other. But the idea being, we have to get the right information architected at the beginning to the oracle, the expert, the human who's going to weigh in, and feed that with other contemporary pieces of data that, Maria, you want to receive or your clients want to receive and manage across a dashboard so that they can buy, sell, trade, incarnate an investment thesis, manage a portfolio, manage risk. And Maria, that was an intended throw to you.
Yeah, I think that's right. I think, John, I actually really like the way you put it. Systems built for architects, right? So I think that is exactly what we're moving towards as we're becoming more and more data driven, right? So one of the things we're doing at Plum Labs is, again, taking all these data sources, we're trying to abstract away engineering so people can think about the data science, right? Like, how do you, put these structures towards building dynamic models that understand data as they're coming in? So you could just you could reimagine something, reimagine the way things are calculated, reimagine the outputs, right? And so I think there's been this weird polarized dichotomy of data consumers relying on very static applications and old school enterprise technologies that we all know from the EMS, OMS, RMS space, whatever. They're quite monolithic, and then you have the most sophisticated companies who are just using very raw infrastructure. They're using their S3, layering on their Databricks, using RStudio, maybe using MATLAB, modeling from the ground up every single time they are looking at another data set. And they do that because there was no standards, right? And they need to train everything from the ground up. And those people are more likely to enter new products and new assets because they understand what the features of that new data is, whether it's oil or water or whatever it is, right? And they put it into their models and they run it and they, generate alpha, really, right? Everyone who's using the application layer, right, the construction workers, as we'll call it, right, which is what we all grew up doing, we're just consumers. We're looking at data very passively, right? And if we're moving to a future where everything is operating off of dynamic data that's constantly being generated, right, through this new digital financial product revolution, and combining that with AI models and LLMs that are like feeding, different applications and feeding investment decisions. We all need to move away from that far end of the spectrum where we're all like kind of just consumers of these static pixelated works of art. And we all need to kind of figure out, how do we consume more dynamic models that are developed by architects, right? I don't know what that layer is. Like, what is that new type of UI layer that makes that information consumable to people? But it's not BI, it's not analytics, it's not visualizations anymore, right? I think this is all something that we all need to think about, right? It's a new sector.
Yeah, Maria, let me just kind of jump on that for a second, because what I see is a distinction. If you look at corporate bonds, very old market, and in fact, the structure of the corporate bond offering drives corporate bonds. Nobody comes up with innovative corporate bonds because you can't offer them, you can't bring them to a market. What you're talking about in particular in private assets is making distinctions amongst assets because you actually understand their characteristics at a very fundamental level, all the way down to details. And that's where portfolio managers are going to get alpha. It's not going to be from getting a better optimized corporate bond portfolio. It's because you find some alpha in individual securities. And that
100%.
And that doesn't exist yet. That's what we're building. Let's find.
It doesn't exist. And this is how we. Yeah, and this is how we kind of get away from this like regulation conversation that's like never effing ending, right? It's like it shouldn't matter at this point what classification a product is, right? It shouldn't matter. You should look at its metadata. You should look at the fundamental functionality of these new assets, these new financial products, and then classify them accordingly, right? We shouldn't just say you were born being this name, so that's how we're going to classify you. Like, that's not logical anymore, right? Because that's just not how data works. Data doesn't care what label you put on things. That's just what people care about, right? Machines don't care. They're just inheriting those labels. And so I think that like we need to start thinking of things a brand new way. And when I first talked to Pat like a couple of months ago around what I was doing with Plum, I said to him, I know my mission is going to be difficult because I'm trying to affect change, right? I'm not just doing the same thing that we've done before, which is build a bunch of models that have a preset understanding of what a corporate bond is, what a default swap is, what a Bermuda swaption is, whatever, and trying to fit different formats into that. Like, I'm trying to create an application layer that doesn't care. Right? And what can you imagine if you didn't care? Wouldn't it be so much easier to buy a tokenized real estate bond if you didn't care that it was like some digitally created product that had like some factors that you didn't fully understand? All you needed to know was how they behaved and that you could profit from them. Wouldn't it be much easier for you to distribute your products as like a token issuer, as a crypto asset issuer, as a stablecoin issuer, whatever it is? I think so, right? So I'm trying to abstract all that away.
And I think that Kevin, in the for those who are watching, Kevin in the kind of the chat that's happening between the speakers had one of the great lines where he gets to be super snarky, where he said, "Isn't it great when you can predict things that happened 6 months ago?" And I think one of the realities is the models work until they fail completely, and we need to build it. And the number one mechanism is, how do I come up with a new model to do it? And the supercomputer that allows people to see when a model is beginning to break is the human brain, called a trader. Right. So you can talk about long-term capital. They failed when they moved it down below. One of my favorite concepts, particularly in risk, is decentralized versus centralized risk management. And more of the world tries to move to a centralized risk management. And I use, in 2008, SocGen was named in Risk Magazine, which I think is away, which is a great story, right? Risk Magazine, they said the risk manager of the year was SocGen, as they created this giant world invest all these PhDs, risk management, where risk was not possible. You can't go beyond your trading limits. And then literally months later, they had that ex-currency manager in Baltimore who blew up SocGen, right? Do you guys remember that? And this is literally 2 months after they won Risk Manager of the World, because they couldn't imagine that there would ever exist a risk manager who was the branch manager, the FX manager, and compliance manager in a single branch, right? And they wanted this centralized location. And I compare that to Goldman in that exact same period where they invited all the managing directors in, right as everything is blowing up in 7. And they're saying, tell us what you're hearing. Tell us what you're hearing. And senior management listened to all of their MDs saying, what are you seeing happening? And that was the supercomputer of the management team listening to distributed risk, right? And the market in a distributed risk that can speak to each other, where you're delivering data, Maria, that you're talking about with all the metadata, that we're going to find that there's not going to be a single oracle in the middle that's going to tell everybody what is happening. There's going to be millions of oracles speaking to each other, and the people who can understand what the oracles are saying are going to get there. Does that make sense? And what I think this decentralized solution where data is flowing at scale, at a volume that has not been done before, we need John helping inform, guys, this is the way to get the best information out there, right? In this decentralized new reality that we're building. Maria saying, hey, here's mechanisms to interpret this volume of data in new ways, right? And create something whole cloth. It's not a 2% increase. And rather, what is this decentralized risk management? And we're pushing, in a form of subsidiarity, more responsibility to the lower levels instead of a single centralized solution. And I feel like I've gone on. That was a diatribe that maybe wasn't appropriate for this podcast. But Kevin, I want to really go back to you as we were talking about, application, model, human valuation. Have they converged? Are they? At what point are we going to see the interaction working at the highest and best level? And what is the next generation as we think about these various things being put together?
Well, I mean, I think, what we don't want to acknowledge is that, almost by definition, alpha comes from a variable or data that isn't in the current model, because if it's in the current model, it's already priced in to the asset, and that alpha comes from one of those features in a data flow that you haven't thought about, but that also you haven't thrown away, to John's point, which is you had to collect it and you had to keep it, and it probably isn't centralized, and yet somehow you want to understand and incorporate it into the next generation of the model. And I mean, that's why it's so cool to have the flow here. But I mean, in particular, I think my question or my thinking is around what is Houlihan Lokey's role. It's, the humans are good at, as you pointed out, the managing directors are good at actually listening to a broader set of variables and just lived experiences than a fixed equation in a model. But as we get more and more towards AI and the ability to sort of look at all data and let the features speak for themselves, the role of the humans, I think, is changing. And that's why I thought Albert's answer was so interesting of 6 months ago. And I want him to tell me more about what happened 6 months ago that has already changed some of the thinking around this.
Albert?
Yeah, it's a pretty easy answer. Amazon invested multiple billions of dollars into integrating an enormous amount of AI functionality into their infrastructure, and that makes it kind of turnkey to be able to integrate AI functions into the AWS products that everybody's already using. And I want to make another point about this. In order for AI to really be suitable for enterprise, it has to have two things. First, it has to be useful, but it has to produce useful results. But in producing useful results, there's a corollary thing it needs to be, which is it needs to be trustworthy. This is something that people underestimate, but is incredibly important, and we work on it at Inveniam all the time. Does anyone check the gasoline going into your car when you go to the gas station before you just stick it in your tank? Even though if there was something wrong with it, that would be a pretty big problem, right? Nobody checks it because it is assumed that it is exactly what you expect it to be. And that is what we are going to have to get to for AI to be usable and integrated into enterprise processes on a regular basis. You're going to have to, have clear ideas of where data came from, that it's right an enormous amount of the time, and then that you can trust it. And then, of course, all of that is secondary to, is it the thing I wanted? Is it the data I needed in the first place?
And that's going to drive an explosion of innovation because instead of the sonar going from macro to micro only, because only the macro players have enough money to really do that data diligence, right? Like back in the day when there were only mainframes and the biggest companies in the world were the only ones who had compute, right? And then all of a sudden it went to desktop, Bill Gates democratized compute, and innovation exploded. You're now going to have micro from the real estate going up, shooting that sonar, waiting for the signal back, right? Saying, where is the best market for me to go to, right? Because as you said, there's only one place to bring a corporate bond today, right? When there are 30 DeFi protocols, plus Bank of America and Morgan Stanley, you know what I mean? And any number of other mechanisms in order to finance something, you're going to see the micro pinging out into the world looking for the bounce back data, just like the macro sends the data down and gets that back. And I think what we're talking about is big data being democratized, sitting at your desktop, so that there's a democratization of function. The smallest players in the world can compete and maybe are more nimble in this world than the biggest are. Does that make sense? And that's where there's excitement. Go ahead, David.
Well, yeah, so Pat, yes, democratization is critical for the market, but I wanted to get back for a minute to this comment that Kevin made about humans, models, as this thing converged. And if I look back, maybe it's 10 years now, I used to sit with interest rate swap traders who were the gods. They seemed to know exactly what would happen without very much data at all. And then suddenly they got this thing called algorithmic trading, and electronic execution showed up. And as the data of the markets became much more important than that trader's perception of the market, the way that trades happened and who made the money in them changed. And that was a highly liquid market. And you could watch, you could watch the kings of the universe see their universe slipping away as they could see that data and the execution value went to other venues and to the ones with the better algorithms. So that process continued and democratized because that fundamentally it broke the stranglehold of a fairly small number of highly interconnected, completely analog decision makers and went entirely the other direction. Now, if you look at private asset markets,
hey, before we go there, because I want to ask a question, right? But because I'm anticipating what you're going to say next. I don't know that it democratized it. It just moved it to new players. It all went to Sequoia and Citadel, right? So it's not like a whole bunch of firms got it. 3 firms got it. Is that fair?
Yes, TradeWeb got it. Some venues got it, but yes, it wasn't fair enough. Not a democratization, but it did sort of break the cabal or the cartel of banks owning that market.
Yeah, Susquehanna. Did I say that? I think I said Sequoia instead. Excuse me.
Right.
Yeah.
But now, when you look at private assets, if that market is ripe for exactly the same disruption, except Albert, Kevin, it's going to take a whole lot of compute power, a whole lot of data to be able to create that same kind of seamless liquidity, algorithmic execution. Like we're nowhere near that, but to move in that direction requires a huge amount of compute and brains and data science. But it is the direction we're going to find alpha and disrupt that market.
Maria and John, I'm going to throw it right to you. David, I could not agree with you more. Last week we had Fiat from G42, who owns the world's largest commercially available supercomputer. Right right now, I think, I don't know what it's at, 16 exaflop. They're building 150 exaflop computer. Microsoft co-invested 14 billion into it. They're building this massive computer to do that. And what we want to do is make sure all the economic benefit doesn't go to 3 people. We want it to go to a lot of people who can rent it on demand. And to do that, we need John, you at one end, and Maria at the other. Right, from the asset to the risk model user being able to ping each other and rent that compute at scale. And I'll throw it to either one of you who wants it, John, Maria. And if you want to just talk about something else.
I'll take a go at this and I'll pass it back to you. No, it's this is a great topic. So I want to quickly just hit on democratization. So David, I grew up in HFT, right? I worked at a company called ITG that was very early in using technology to run stat arb strategies, and we took away that control from a lot of people who were on the floor just doing their thing, right? And the reality is, like, we coded logic that people understood into algos, right? That I made a career out of writing algos that did executions, right? And so that is a form of democratization, despite the fact that all of that tech was with 3 people. Well, what happened is that, like, technology costs money, right? So you need to throw money at these problems, right? Otherwise you don't get access to it. It's the same thing with, like, ChatGPT, right? So you can use the free version, which is pretty shitty. It's just like kind of like souped up Google search, or you can pay for it and use a really cool thing, right? It's the same thing for AI. You're saying that, like, a lot of tech is concentrated with, like, 3 private companies. That is 100% accurate, right? But the reality is, like, they're throwing money at this. They're investing in these in this innovation, and we hope that eventually it will be distributed. But they're benefiting from it first, and that's the only way these sectors grow, is when the private sector takes control and throws a lot of investment, a lot of resources at these things and develops these models, right? I mean, AI has existed for a long time. We just called it statistical analysis back when we were using it, right? It's been available, but it was just limited to researchers. Kevin, you're laughing. You might have been one of those researchers, right? That were just, like, doing this analysis on the side, probably with some university affiliation with, like, very limited funding, and then suddenly the private sector took it to another level, right? Like, that's what happened. And so going back to this, like, point of democratization, AI democratizes knowledge, right? So there's not knowledge concentration of financial products and how to profit from them that's concentrated with, like, a few elite traders, but it also democratizes how financial products are created, right? And so then there's this, like, really sick intersection between AI and blockchain that occurs, right? So blockchain is private, right? Private, limited to a couple of layer 1s and layer 2s that created financial products, right? Private. Then they opened up access and made it so any developer could go and create their own financial product. They can create their own token. They could create their own stable coin, whatever it is, on blockchain, right? So that's democratization. Then AI takes it to another level and says, I'm going to extract away that knowledge concentration from these few Solidity developers who know how to write smart contracts to, like, creating anything, right? Anything is possible. Now, if you add AI to this factor, they can create any financial product. And it is democratization, because prior to all of this, David, the world that you and I are talking about, the creation of financial products was limited to Bank of America, JP Morgan, Goldman Sachs, Morgan Stanley. That's it. Nobody else was creating financial products. They weren't allowed to. They could not do it. And now it's 2024. Everyone can do it. So that is democratization. And I agree there's concentrations of it, but those private sector concentrations drive how people can access these technologies in the future.
And
Can I
that was
piggyback off that, Pat?
fantastic. Yeah, please.
So if you take what Maria said and you swap finance professional for architectural construction professional, the exact same things applies. You have some large mega developers who hold some percentage of the intellectual capital, and then a whole marketplace of subcontractor consultants. And I think those subcontractor consultants actually have more power and influence than those monolithic organizations. And the decentralization, the framework is going to give these independent parties more sophisticated tools to actually attack those monolithic infrastructures and say, I can compete, if not outperform, at a fractional of the cost, right? At the fractional of the resource because of automation. So who are we trying to automate? Are we trying to automate the monolithic, already automized, automated to nth power already, or are we trying to automate data strings that are democratized to new independent contractors who can use this as a leverage to upskill, develop, outperform? And in many ways, this is how I see us attacking the general macro right now. What does commercial real estate look like in most countries of the world right now, but especially in the US, right? We have a great revaluation happening because of interest rates and a number of different things. So if we're trying to democratize tools with AI, right, what tools are we democratizing? Is it the risk assessment analysis? Is it architectural design? Is it implementation and as built? Like, is it the whole thing packaged combined so that the end result is that favorable accounting, from design? That's where we have something that I think you can make a strong argument about how we fix such a large macro issue. What are we doing with all this commercial real estate right now? We're not going back to the office. We might be putting robots in the office, but we're not all going back.
I think that's an interesting endpoint where we're collectively. Yesterday, I was on a call where New York is at 30% utilization of office space and is at a high point. And I believe it was JP Morgan, it might have been Citi, who just said everybody has to return to the office, full stop. You cannot stay out. You got to return to the office. In second cities, that number is like 38% utilization of rented space. I'm not talking about 38% of all space, 38% of leased space, right? And you look at this and you just go, wow, we were talking with ABN AMRO, the head of the risk for their book, and they're talking about the entire country is below 40% utilization of leased space, right? And I mean that's kind of amazing, right? And so for the Netherlands, and there is going to be a change that's coming, and in the ability to perceive where the evolution is going to early and invest against that is the opportunity, right? And how do we do this? How do we catch this? How do we manage this all the way end to end? And that is a solution that does not need Plum Labs. It does not need Elevator. It does not need Houlihan Lokey. It does not need Inveniam. It needs all of us, right? Like it does not work if Inveniam is not feeding Plum Labs, and we don't have Houlihan Lokey and we don't have Elevator, and it's not together achieving that outcome. And I'd like to just give everybody a chance to give kind of the final parting shot as we end up here. Albert, your brother, final words.
Yeah, just real quick. I think too many companies are focused on using data to predict the future. And I think there's a really great opportunity, better than any time in history, to use data to predict the present. So I would encourage you to look into that.
David.
Or recent past. I mean, there's still good money in predicting the recent past.
I think that fundamentally entrenched industries have to really think about what's going to drive them going forward and understand that the data will, buyers and sellers will be driven by data. And if you're driven right now by private revelation, you're under threat.
Amen. The John.
I'm happy to be here today, as always, Pat. I would love to see Ralph in the next invitation I get to this podcast. I'd love to see what Ralph and Kevin and Albert and I can get into some trouble in a conversation. I'm excited about that.
That's so great. Kevin, anything?
Nothing else.
Maria, you have the final word.
Yeah, here's my final thought. That after 70 years of training, only 0.5% of the world's population knows how to code. And that tells me that nobody has interest in doing this. And so I think the key to the future is abstract it all away using strong data infrastructure, combine it with like modern tech, whether it's AI or whatever the next thing is, and give people the ability to architect solutions without like monolithic, rigid applications on the end.
If it can't be dynamic with the volume and velocity of data, it will break. It's got to be dynamic. Well, guys, what a pleasure to have all of you. It's a pleasure, and we'll see you guys soon. And next week is going to be part 2 of this discussion.